Good morning, I'm Bonnie Quinn.
And I'm Doug Krisner. Here are the stories we're following today.
SoftBank-owned ARM Holdings made quite the splash in its Wall Street debut. Shares of the UK-based chip designer jumped, get this, 25%. ARM raised more than $4.8 billion in the biggest initial public offering this year. CEO Rene Haas told us what the current artificial intelligence boom means for the company.
AI is everywhere, and if it's your edge device like the Assistant or the Alexa or your autonomous vehicle, that's all AI. And now we're seeing it in the cloud and the data center with all the growth of NVIDIA. NVIDIA announcing one of their newest products, Grace Hopper, that is based on ARM. So ARM is everywhere relative to AI.
That was ARM CEO Rene Haas. ARM shares opened at $56.10 and closed in the regular session at $63.59.
We are hearing Walt Disney has held exploratory talks about selling the ABC network and the ABC TV stations to Nexstar Media Group. Now, these discussions apparently are preliminary, and sources telling us Nexstar would only be interested at the right price. Here's Bloomberg's Chris Palmieri.
Rumors about a deal like this have been going on quite a while. The difference is, we saw in July Bob Iger coming out and saying, hey, this is probably a business we don't want to be in long term, the legacy media networks. We know they've basically been up for sale.
That is Bloomberg's Chris Palmieri. By the way, Disney saying today no decision has been made on selling ABC, and it's open to options. And separately, we are hearing that Disney is cutting its target for subscribers for the Disney Plus streaming service for 2024. The company is expecting basically a shortfall by tens of millions of subscribers. Disney Plus has been losing customers largely because of some hefty price increases, and it's also been impacted by collapsing demand in India. That's after the company failed to win cricket streaming rights. Funny.
United Auto Workers President Shawn Fain, Doug, is preparing to hit all three Detroit car makers with targeted walkouts at strategic locations in several states. Now, a work stoppage could still be avoided, but the UAW and General Motors, Ford and Stellantis are approaching a deadline to agree on a new contract. Let's get more from Bloomberg's David Welsh.
The vibe coming out of the union right now is the president is itching to strike. He says he's not, but he's making plans. The rhetoric is still really strong against the car companies, against rich executives, all of that stuff. So he's getting people riled up. He says they're far apart. It doesn't sound like they are if you look at the numbers. So I think they will. And look, it could go on for a while. I don't think it'll be something like 3 months, but I could see the strike going on for weeks. And it could vary by car company, too.
That's Bloomberg's David Welsh. If no agreement is reached, this could be the first time the union takes action against all three companies at the same time. UAW President Shawn Fain will be holding a news conference at 10 p.m. Wall Street time.
We go to China next, where the PBOC cut its bank reserve requirements for the second time this year. We have more from Bloomberg's Yvonne Men in Hong Kong.
The People's Bank of China has lowered the RRR for most banks by 25 basis points. The weighted average RRR for banks will be 7.4% after the reduction. Economists say a RRR cut was expected because of the large amount of special bond supply set to hit the market this month. The central bank said the cut will help maintain reasonably ample liquidity in the banking system. Economists estimate that the reduction could free up $55 to $69 billion. Bloomberg economics say the PBOC could still trim its policy rate by 10 basis points later on today, but the consensus is for a hold at 2.5%. In Hong Kong, I'm Yvonne Mann, Bloomberg Radio.
Well, GOP lawmakers have been pressing the Biden administration to completely cut off Huawei Technologies and the Chinese chipmaker SMIC from their American suppliers. Now, this comes after Huawei launched a new phone. It uses highly advanced technology that the U.S. has been trying to keep out of China's hands. This phone is, or utilizes, I should say, a Chinese-made 7-nanometer chip. It appears to rely on U.S. technology, and it's really stoked a lot of debate in Washington over the effectiveness of U.S. attempts to curtail China's technological and military prowess. Daybreak Asia and an update on global news is next. As we have been reporting, we shall find out a lot more tonight about the UAW's plans for its labor dispute, how this may play out. It will unfold at 10 o'clock Eastern Time in the U.S. Ed Baxter has been covering this story, also with an eye to what we may get out of the White House. Ed.
Yeah, that's right, Doug. Major question today. Can President Joe Biden get involved in the UAW auto industry labor dispute? Well, Bloomberg's Gabriel Coppola says he has imaged himself as a friend of the middle class and organized labor, but
I think that, he's limited in what he can do, both legally and, but I think he can't, he needs the success of the automakers just as much. Right? Because if the automakers don't have a deal that's sustainable, then they're not going to support these jobs of the future.
And a sad reality, Ford CEO Jim Farley has just come out with an interview saying that things, whatever is being said in public are just not moving.
What the UAW is offering us is a choice between going out of business and bankruptcy.
Again, the workers are set to target strike at midnight unless there is an 11th hour agreement of some kind. House Speaker Kevin McCarthy today sending a clear message to the right wing of his party. No government shutdown.
I told my conference, I know tomorrow is a Jewish holiday. We'll be out of session. But when we come back, we're not going to leave.
Meanwhile, House Minority Leader Hakeem Jeffries says the threat is still there.
House Republicans have made clear that they are determined to shut down the government and try to jam their extreme right-wing ideology down the throats of the American people.
So first there'll be a showdown between McCarthy and the right wing of his party.
Threats don't matter, and sometimes people do those things because of personal things, and that's all fine.
Oh, yeah. And then he'll have to fight with the Democrats. After a deal broke down earlier this summer, a plea deal, Hunter Biden has been indicted on federal charges. Bloomberg's Nancy Lyons has the very latest.
Hunter Biden is charged with 3 counts related to the purchase of a Colt revolver in 2018. He allegedly lied on the form that's required to buy the gun that he was not using drugs. But that was a period when the younger Biden had acknowledged struggling with an addiction to crack cocaine following his divorce and the death of his brother. The felonies carry maximum sentences between 5 and 10 years in prison. A special counsel is still investigating Hunter Biden and could file additional tax charges. In Washington, Nancy Lyons, Bloomberg Radio.
All right, Nancy, thank you. And Hong Kong has kicked off a campaign to stimulate its nightlife as officials seek to bolster the city's attractiveness and revive an economy battered by years of pandemic isolation. The promotion, called Night Vibes Hong Kong, will feature 3 evening bazaars at waterfront locations next to Victoria Harbor. All right, on a jet and going. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. In San Francisco, I'm Ed Baxter, and this is Bloomberg.
Now you can get the latest news whenever you want it with Bloomberg News Now. It's the top stories from our global team of reporters at the click of a button. Get Bloomberg News Now on the Bloomberg Business app or at Bloomberg.com or anywhere you get your podcast. Daybreak Asia, and our special guest is the former head of the Dallas Fed Bank, Rob Kaplan, is with us. Rob's also CEO and president of the Draper Richards Kaplan's Foundation. It's a pleasure to see you once again. Thank you so much. We've got this Fed meeting coming up next week. I'm less concerned about what you think may or may not happen, and I'm more interested in getting your perspective on how difficult it is when you get to the end of a tightening cycle to kind of engineer this and allow markets to kind of adjust, but not to become overly enthusiastic that we're necessarily done with tightening.
Well, every cycle is different, and this one is different. And here's how it's different. A lot of the key drivers of what we're seeing right now are happening away from the Fed. What do I mean by that? Government spending, unspent ARPA money, which is in the hundreds of billions of dollars at the local level, the Infrastructure Act money, Inflation Reduction Act money, is all being spent in significant size in the U.S. economy. That is helping to stabilize and give resiliency to the U.S. economy. In my view, without those 3 sources of spending, my guess is the Fed would have stopped raising rates maybe a couple of moves ago. It might be at 4.5 and 4 3/4, and we might even be in a downturn right now. So that's significant. And the second thing that's significant is because of the energy transition that we're executing here and around the world, we're limiting fossil fuel production in the United States. We're undersupplied globally. And oil prices are very significant elements of inflation, directly and indirectly. And so the challenge for the Fed now is if you had told people a year ago they'd get to 5.25, 5.5, you'd say, oh my God, we may not need to go that far, and the economy would be very slow. It's instead very resilient, and inflation is still sticky. But I would argue there are structural drivers away from the Fed. So the decision for the Fed is, how do you end this cycle when you have this amount of stimulus fiscally, and should you talk about it? Right now, they've chosen not to talk about it, thinking it's out of their lane. But without it, they're going to need to keep their options open, that they may still need to do more, even though I don't think they'll do anything in the September meeting.
How many more times will they need to go? The situation sounds a little more dire when you put it the way you just put it.
I don't know the answer to that. I do know that anything interest rate sensitive right now is very weak. If you're a small, mid-sized business, it is very difficult to get a loan. If you're in the goods sector, business is very weak. So there's a number of sectors of the economy that are affected by the Fed funds rate feel like they're in a recession right now. Then you've got this counterforce I just talked about of government spending that's going into construction and is really going into services, meaning if you have workers that are working at these new projects, they spend money in restaurants and they fly and all that other. And so the truth is, if I were at the Fed right now, I wouldn't act in the September meeting. I'd probably be inclined to be more patient than even November before I acted, but I would certainly leave open the option that I might have to act. The thing that would bother me is I'm not raising rates because of the organic strength in the economy. I'm raising rates because of the artificial extra stimulus being created by government spending. And the thing that would scare me and worry me is when the government spending starts to dry up, not in 23 or 24, but into 25, we may have a lot more fundamental weakness than I would like. But that's the reality I'm dealing with if I'm at the Fed.
So many things to talk about, too. The balance sheet roll-off seems to have been done pretty well so far. I mean, it hasn't created too much disruption in markets, near as I can tell. Although in March, we had a lot of stress building in the regional banking complex, a couple of bank failures. Some people were pointing the finger at the Fed, saying this is the consequence of aggressive tightening. We can put that aside right now. But in the interim or intervening period, there have been calls for a lot more capital on the part of banks. A lot of the regulators saying, hey, you need to put more aside in the event that there is some stress that continues to build. Jamie Dimon, for one, has pushed back against this. How do you see the overall banking system right now?
So a rough estimate would be if the Fed balance sheet went from 4 to 9 trillion pre-COVID to after COVID, it's now running it down to closer to 8. The best estimate I've seen is half that increase went into bank deposits. Mm-hmm. As the Fed is running down the balance sheet, as you note, it puts more pressure on bank deposits. Plus, bank deposits are repricing to a higher level. Plus, the backup in longer-term yields have eroded bank capital. So most banks I talk to right now are very concerned, quietly concerned about further bank deposits. They're very worried about their earnings being weak, and they need to show good earnings for the regulators and for the depositors. And they're being extremely careful about loans to small and mid-sized businesses. And they are, and the requirements for more capital mean there are two ways to fit into new higher capital requirements. One is to raise more money. The other is to shrink your loan book. And what I've seen is they're doing a little bit, they're shrinking their loan book and being very disciplined on loans. The thing I don't love about the requirement to raise more bank capital, the issue we had in March was not about bank capital. It was a supervisory lapse hiding in plain sight, where the banks took asset liability risk. It was well known to the Fed and to the regulators, but they didn't act to get banks to clean it up. In response, the response has been, you need to raise more capital and we're going to be tougher from a regulatory point of view. But I think a lot of banks I talked to are frustrated. They think it was a supervisory issue, not a bank capital issue. And I think that's what you hear Jamie Dimon saying. This bank capital is not going to help, and it isn't what the issue was in March. The last comment I'd make about the Fed balance sheet, there is one sort of low fever symptom of the balance sheet runoff and all this government spending, and that's the backup in the 10-year. So we don't talk about as much as we should, but the 10-year Treasury has backed up a good 50 basis points. That is a very significant move, and I'm not sure it's over yet. And so is there some symptom of the runoff? We don't have as many natural buyers for Treasuries. Used to be Fed was one. Banks, we know, were one, but they're not going to buy anymore because it created the problems in March. Yes. And so I would be watching, and I do watch very carefully right now, two things: where the 10 years trading, and what's the price of oil. And those are two factors away from the Fed that are concerning.
Well, WTI is above $90 a barrel, as you well know today. Rob, it sounds like you're describing a scenario where the transmission mechanism sort of works through small businesses, and next year we might get a slowdown. Will there be a drop-off in employment that will cause a recession?
So I don't know, of course, but I would guess there will not be a recession this year or next year. And the reason is the amount of government spending for the rest of this year and next year. And by the way, you notice that if you asked me 6 months ago, I think the best estimate on the deficit for this year was $1.25 trillion. It's now $2 trillion. Okay, we're running a very high pre-recession deficit.
It's an election year, though. Does that make a difference?
Well, I'll leave that to others. I think the point of this is this amount of spending that's a meaningful percentage of GDP is the main reason I think that we've got stability. We don't have slower GDP growth. It also means that the employment rate is going to stay, unemployment rate, very low. There's substantial demand from every one of these projects for jobs. There aren't enough workers to do these jobs, and there's a lot of job switching to fill these jobs. I think this is a reason why the Fed, I hope they don't, may need to do more, and will need to keep rates higher for longer. And that's the trade. And you may see the 10-year back up further.
So we're at 428 right now. Can you see a 10-year at, let's say, 475, another 50 basis points?
So I'll take you. Here's how I'd look at it. People are saying, gee, when the Fed starts to cut rates down somewhere in the future in 2024, maybe the 10-year will ease off. I think the bond market has already looked through that, and it said if inflation stays sticky, price of oil might be one of the reasons, and the Fed is able to get the Fed funds rate down to, say, 3, for example, 3%, at 150 basis point term premium, that gets you to 450 on the 10-year. Wow. This is why a lot of intelligent people are saying, I know there's been backup in rates, but I'm not sure we're at fair value now.
Wow.
And that's why I'm watching this very carefully, because it could create a further tightening in financial conditions, assuming the Fed is going to cut.
This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street.
Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast.
You can also listen live each day on Bloomberg 1130 in New York, Bloomberg 99.1 in Washington, Bloomberg 106.1 in Boston, and Bloomberg 960 in San Francisco.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130.
Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, Channel 119, the iHeart Radio app, and on Bloomberg.com. I'm Vonnie Quinn.
And I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.